Internal Revenue Service IRS tax news. Here's what taxpayers need to know about the home office deduction. IRS Tax Tip 2020-98, August 6, 2020. The home office deduction allows qualifying taxpayers to deduct certified home expenses. There's a link to certified home expenses here on their tax return. With more people working from home than ever before, some taxpayers may be wondering if they can claim a home office deduction. There's a link to the home office deduction here when they file their 2020 tax return next year. Here are some things to help taxpayers understand the home office deduction and whether they can claim it. So obviously we're going to have more people working from home right now. You probably carved out a space in your home that you are working in. And then the question is going to be, well, I'm using this basically for work. Is it possible that I can get a home office deduction related to the space that I'm consuming for work? Back to the text. Employers are not eligible to claim the home office deduction. So the first thing is typically the home office deduction is going to be for those that have a business, like a Schedule C type of business or a sole proprietorship, that are reporting their income on the Schedule C. So most likely, if you have a home office deduction, there's a lot of people at this point in time that might be working, but be working less time possibly, or have more time to do other things from home, and possibly have a side job that they're working at home, in which they're working as a small business, a sole proprietorship, where they're going to be filing a Schedule C. It's most likely that if you have a Schedule C, then, that's the place where you want to think about whether or not you would qualify for the home office deduction. Back to the text. The home office deduction, Form 8829, there's a link to the Form 8829 here if you want to check it out, is available in both homeowners, to both homeowners and renters. So whether you own your home or you rent the home, if you qualify for the home office deduction, then you can use the home office deduction. It's just going to have a different impact based on which camp you fall into, right? I mean, if you rent the home, then one of the big items that you might be applying to the home office is the rent on the place, the kind of like the part of your home then you're thinking about as basically office space that you should get a deduction for. But if you own the home, then you still have payments, but you might have basically mortgage payments and then interest and whatnot on the mortgage payments. Now, it's a little bit more tricky because, note, you already get a deduction for the interest payments on the loan when you own the home. So you have to, and that's going to be on a Schedule A. So then you have to kind of think about whether it's best or how you're going to split out between the deduction that you might take for interest expense that would be on the business use of the home versus the itemized deductions, the Schedule A type of deductions. If you own the home, the other factor to consider is depreciation. So in other words, if you were to buy a property that you were going to do business in, you would get a deduction, but it would be in the form of depreciation. You'd be allocating the cost over the life of the use of the property. So you bought the home and now you're using it basically as property for work. So you may be able to then think about the depreciation related to that portion of the home as possibly a deduction as well. Now again, that gets a little bit confusing because once again you're going to have to think about the portion of the home that is going to be used for the business, and then if you were ever to sell the home in the future, you got to take into consideration the amount of the accumulated depreciation that has been taken already, consumed basically, or used for tax purposes as a deduction, an expense during the time period when you figure out the gain, if you were ever to sell, or loss, gain or loss on if you were ever to sell the home in the future. So it's just a couple things that you want to consider when you're a renter versus the buyers. Let's back to the text. There are certain expenses taxpayers can deduct. They include mortgage interest, insurance, utilities, repairs, maintenance, depreciation, and rent. So when you're thinking about what else you can allocate, the two major things, the big things obviously are going to be rent or the interest payment, the payments you're making basically on the home, and possibly the depreciation. But they also include, so that would be the mortgage interest if you own the home, insurance. So if you have insurance that you're relating, so if you're having insurance that kind of relates to the entire property, then you could take a portion of that insurance that you're going to apply then to the home office. Same with utilities, because if you think about utilities, they apply to the home as a total. So then you're going to say, well, some of those utilities I'm using for business, so you're going to be able to apply a portion of them possibly to the business portion. Repairs, same type of thing. If you're doing a repair that's general for the whole home, then you may be able to take some of those repairs that are specific to the business. Now, notice the repairs and maintenance. Obviously, if you do repairs and maintenance on your office itself, then you might be able to take 100% of those repairs and maintenance because they're actually on the office. But if you're repairing like the roof or something like that that's covering the whole house, then you're going to want to, then you might be able to take kind of a portion of it, just like you would think if you were doing like the utilities or something like that. Depreciation, once again, that would apply to someone who owns the home as opposed to renting it. So now you've put down the cost of the home, and typically when you buy like rental property, you get the expense in the form of, or the expense which is a deduction in the form of allocating that cost over the time it's used. That's called depreciation. So now that you're using the home for a business purpose, it should be, you would think that you would get that, be able to take that depreciation. And then the rent, of course, would be involved if you're renting the property, and that would be one of the biggest components of the deduction for a rental property, allocating portion of the rent to the business component, which is fairly straightforward because you would think about the business property or your home property now as a portion of it being business property. So it would make sense from that standpoint to allocate some of the rent to the business portion of it. Okay. And notice everything behind this whole concept is that if it was for personal use, it's not deductible, right? Things that are going to be deductible are those things that are used in order to help you generate revenue. So the tax is there to tax you on your net income, in essence, your taxable income, revenue minus expenses. So it's not really fair to tax you on your gross income, because it might have cost you a lot of expenses, depending on the industry you're in, to accumulate that gross income. So the idea here is, well, now if it's a business expense, if you had to do it in order to generate revenue, then it should be something that you would get a deduction for, because we only want to tax you on net income. If it's a personal expense, if it's your own house that you use for your personal use, not to generate revenue, but for your own benefit, then it's for general purposes, you would think not something that would be deductible for taxes, right? For taxes, things that you normally would think would be deductible. This is the general rule. It doesn't apply across the board. Taxes have a lot of other things going on. But in general, you would think that if it was something used in order to help you to generate revenue, then that's the type of thing that the tax code should allow to deduct, because they're trying to tax you on your income. So anything you consumed in order to generate that income, you would think would be a legitimate deduction in general. All right, back to the text. Taxpayers must meet specific requirements to claim home expenses as a deduction. Even then, the deductible amount of these types of expenses may be limited. The term, quote, home, end quote, for purposes of this deduction includes a house, apartment, condominium, mobile home, boat, or similar property. Also includes structures on the property. These are places like an unattached garage, studio, barn, or greenhouse. So if you're, obviously if you're working in the garage or something like that, then that would be falling under the categorization when you're thinking about the home office deduction as home for part of the home office deduction. So it doesn't include any part of the taxpayer's property used exclusively as a hotel, motel, inn, or similar business. So if you're thinking about a hotel or motel type of business, you're going to have to get into the specifics of that area. So back to the text. There are two basic requirements for the taxpayer's home qualify as a deduction. There must be exclusive use portion of the home for conducting business on a regular basis. For example, a taxpayer who uses an extra room to run their business can take a home office deduction only for that extra room, so long as it is used both regularly and exclusively for business. So there's kind of this regular and exclusive type of test that we have here. So you got to carve some component of your home out, typically a component of the property that you can then measure, right? You can say, hey, this is how, you can actually physically think about carving this out in your, and then that use you got is going to be business use. So in other words, if you were just to say your whole bedroom the entire bedroom is business related because you have a desk in it, then the IRS is not going to say that's good because you sleep in the bedroom. It's used for other things other than the home office. But possibly if you carved out some component, right, that's basically your workspace, your home office workspace, then that might be useful if you have a separate room entirely that's going to be your office room that you use basically for the business. That would be, you know, a nice, well-defined home office type of deduction. Okay, so back to the text, or home office type of area that you can then use to apply your home office deduction. Okay, back to the text. The home must be the taxpayer's principal place of business. A taxpayer can also meet this requirement if administrative or management activities are conducted at the home and there is no other location to perform these duties. So typically the principal place of business for the home. So like if you had 2 jobs or something like that, notice you're talking about the principal place of business for the business that you're working. In other words, if you have a W-2 type of job, you're an employee, and you also have a side job where you're having self-employment income, then if that place that you're working from home is your principal place of business for the Schedule C income, because that's what we're talking about here, because you're going to be deducting it for the business, then you would think that that would be that's what we're talking about here, right? So the home must be the principal place of business, and then there's an exception to that. A taxpayer can also meet this requirement if the administrative or management activities, so like the decision-making processing activities, are conducted at the home, and there's no other location to perform these duties. So in other words, if you conduct them, the administrative kind of duties at home, then you would think that it would qualify for the home office, even if it's not where most of the work is basically done, even if you go somewhere else to actually do the work. But there's kind of a quirk. If there was like another office that you have that you could go do the work at, like it's available, but you just choose to do it at home, then you may not be eligible, right? But if you do most of the work somewhere else, but you do all the admin stuff basically from home, then you would think that would qualify for this component. So therefore, someone who conducts business outside of their home but also uses their home to conduct business may still qualify for a home office deduction. And you can think of someone like a contractor or something, that if you go out and you do contracting, obviously you're doing most of your work somewhere else, you're helping people do stuff, but then you would clearly think that you're doing the actual administrative work, the invoicing and doing all that kind of stuff from the home office. So you would think then that you'd still be able to qualify. Okay, back to the text. Expenses that relate to separate structure not attached to the home will qualify for a home office deduction. It will qualify only if the structure is used exclusively and regularly for business. So basically, if you're working in your garage or something like that, then I mean, if you've carved out everything in the garage and you're using the garage exclusively for business, then you would think that that would qualify. If, on the other hand, you're using it for all kinds of things, that you have the garage in there, then no, because you got the personal and the business. So this exclusivity of business is what they're looking for. Back to the text. Taxpayer who qualify may choose one of 2 methods to calculate their home office expense deduction. The simple option, there's a link to the simple option here, has a rate of $5 a square foot for business use of the home. The maximum size for this option is 300 square feet. The maximum deduction under this method is $1,500. So, I mean, it's not too difficult to run both of these methods, so you might want to run them both and just see which one is going to benefit you best, because I think the simple method is simple, but it may have a lower cap, so you might want to run both of these. The simple method is just to take the $5, and then take a look at the square footage. So if you have an office that you're working in or some space that you carved out, then you want to take the square footage, pull out the old ruler and, count the square footage of it. And then you can multiply it times the $5. That would be the straightforward or the easier method. So then when using the regular method, deductions for home office are based on the percentage of the home devoted to business use. So the other method is basically using a percentage breakout type of method. So taxpayers who use a whole room or part of a room for conducting their business need to figure out the percentage of the home used for business activities to deduct indirect expenses. Direct expenses are deducted in full. So, you know, the way you would basically do that is you might, again, you still have to get the square footage of the area that you're looking at, but then you also need the square footage of the entire home, which if you look at the documentation when you purchased it or something like that, oftentimes they break out the square footage, you know, how many square feet are in the home, and then you would be breaking out a ratio. So then you'd be saying, okay, this is the square footage of the office, numerator, compared to the square footage of the whole home, denominator, and that would give you a percentage portion that would be allocated to that you can allocate to the home office, basically. So you're taking a percentage of the home, and that would be like one of the most common ways to kind of figure that home office percent. So, right, you can't really take, if you use one little room, you can't really take one little room and say, well, that's one room out of 3 rooms in the home, even though it's a little tiny closet I work in, because that would mean the room's too small. So you would think, you know, it would be an unfair measurement. So you would think some kind of square footage of the place you're using compared to the total would be better. Now, if you think about this $5, that, like, if you apply the $5 per square foot, if you think about this, it's the IRS is applying this to the entire country. So it's more likely that $5 is kind of like somewhere around the average what they've seen for the home office kind of deduction amount. Which means you would think that if you're in a state that that has a reasonable cost of living, you know, that's somewhere in the middle, or then in the middle or lower, then you'd be okay with this simple method most likely. If you're in a place where you have a high cost of living, you would think that it might be worthwhile for you then to be using the full method here, taking the percentage of the home, because your rent. I mean, the rent that you're looking at might be way higher than the rent on average for the country. And therefore you could end up, you know, you might end up in a higher. So if you're in like California or like New York or something, the $5 per square foot may be low, as opposed to if you're living somewhere else then the $5 may be fine. So anyway, so what I would recommend is just run it both ways if you can, right? If you have access to the square footage of the entire home and you want to see if you can maximize the deduction, I would test it out with, you know, both methods and just see what comes out best. If you have software, then that should be able to really kind of help you out to be able to put this information in. If you're using like an H&R Block software or a TurboTax, which is by Intuit, you know, for individual taxes, then you might want to just plug that. It should go through like an interview process to kind of help you walk through both methods. So you might be able to test both methods out.